You've heard the debate, right? It happens online, it happens at family dinners. Who really had it easier economically, baby boomers or the generations that followed? Well, today we're going to put the anecdotes and the back in my day stories aside. We're just going to look at the cold, hard, inflation-adjusted numbers and see what they actually tell us. So let's just start with this because it cuts right to the heart of it. Think about that for a second. A house used to cost about 3 years of your work. Today, that same house can cost 12 years of your work, and that's all adjusted for inflation. This isn't a feeling. It's the math showing how the basic deal has changed. And oh, it was not just housing, not by a long shot. College, it cost a tiny fraction of what someone earned. Even in today's money, a single income could actually support a whole family. Now, even two incomes can feel like a constant struggle. Back then, wages actually grew. And saving money, you could get real returns, sometimes even double digits.
Okay, so let's get one thing crystal clear before we go any further. This is not about comparing sticker prices. It's about comparing purchasing power, what your money can actually buy. Everything we're talking about today is based on inflation-adjusted dollars, on income multiples, on real wages. It's a true apples-to-apples comparison. And frankly, the numbers prove just how much easier the boomers had it. And this right here is the key. This is what we're really digging into. It's the idea that for an entire generation, the economic winds were at their back, pushing them forward. So let's break down exactly how that worked. All right, first up, let's talk about the big one, the absolute pillar of the middle-class dream, owning a home. Take a look at this chart. It really says it all. See that little bar on the left for 1975? Back then, a typical house cost about 3 times what a typical family earned in a year. Pretty simple, right? Now, look at the bar for today. It's a skyscraper. We're talking 8, 10, even 12 times your annual income. That giant gap between those two bars, that's the entire story of housing affordability right there.
And this just nails it. It's the perfect summary. A house wasn't cheap because the sticker price was 40 grand. It was cheap because the price was 3 years of your life. Today, it's 12 years of your life. That's the real cost, and it has exploded. So if homes got that much more expensive, our paychecks must have kept up, right? Well, let's see. This isn't just about things getting pricier. It's about our paychecks losing their muscle. Okay, a quick but super important idea here. Real wages. It sounds a little academic, but it's simple. It's not the number on your paycheck. It's what that number can actually buy after you account for rising prices. It's your true financial power. I mean, just look at this gap. It's a canyon. Since the 70s, the amount of value an American worker creates per hour, that's what productivity is, has just gone through the roof. But our real wages, what you can actually buy with your paycheck after inflation, have basically flatlined. All this extra wealth that's being generated, it's just not trickling down to the people who are actually creating it. And that is the perfect way to say it. A dollar earned in, say, 1975 just had more muscle. It could buy you a bigger piece of the American dream. More house, more healthcare, more security. Today's dollar, even though it's part of a way bigger economy, gets you a much, much smaller piece. All right, let's pivot to another cornerstone of getting ahead in life, getting a college education. Just look at this. On the left, you see the annual cost of a public college back then, but shown in today's dollars. Now look at the right. That's the cost today. It's not even in the same universe. College costs didn't just keep up with inflation. They lapped it multiple times over. This one change has completely rewritten the rules of who can afford to go to school without a mountain of debt. And that's why you hear those stories, right? I paid for my whole degree by working summers. It sounds like a fairy tale now, but here's the thing. It was real. It was actually possible. The idea of widespread, life-altering student debt just wasn't a thing for most people. So beyond the huge price tags on houses and degrees, the very nature of a good job has been totally transformed, especially the financial safety nets that came with it. So check this out. In the 70s, a huge chunk of workers had a pension. A pension was basically a promise from your company. You work for us your whole career, and when you retire, we promise to send you a check every month for the rest of your life. It was a guarantee. Today, that system has almost completely disappeared, replaced by the 401k, which basically says, here's an account, good luck, you're on your own. And this quote just captures that shift perfectly. We went from a system of stability and guarantees to a system of,
Well, hoping your side hustle takes off. The entire foundation for retirement has been ripped out and replaced with something far riskier. Okay, now for the final and maybe most powerful piece of the puzzle. It's not just about the money you earned. It's about what your money did after you earned it. This was the boomer wealth multiplier. The boomer generation was, through a mix of hard work and just incredible timing, perfectly positioned to ride the biggest wave of asset growth in modern history. They bought houses right before real estate went to the moon. They started investing right before the stock market took off on a multi-decade rocket ride. And get this is going to sound crazy, but even saving money used to make you wealthy. In the early 80s, you could stick your cash in a boring old savings account and get interest rates that absolutely crushed inflation. Your money was making you more money with zero risk. Today, your savings account is basically a leaky bucket. And that's the force multiplier we're talking about. Their work was supercharged by an economic environment where their homes, their stocks, even their savings were all working just as hard as they were to build their wealth. And as if all that wasn't enough, there are a few key costs that have just blown past normal inflation. Healthcare has morphed from a manageable expense into a potentially bankrupting one. Childcare has gone from being almost a non-issue to costing as much as a mortgage for many families. And at the same time, the very assets you need to build wealth, like stocks and real estate, have soared in price, making it incredibly hard to even get in the game if you weren't already. So, after looking at housing, wages, education, and assets, what's the big picture? What's the undeniable takeaway? It all comes back to this. When a boomer says we earned less money, they're right if you're only looking at the number printed on their paycheck. But when you measure what those dollars could actually buy, when you measure their real-world power, the conclusion is clear. In reality, they had so much more. Look, the economy they came up in was just built differently. It was structured to provide a lift. The data we've walked through, all inflation adjusted, makes that undeniable. This isn't about finger pointing or blame. It's simply about acknowledging a fundamentally different reality. And that leaves us with the only question that really matters. Knowing this, what do we do now to build an economy that works for everyone?